had a chance to get his feet on the ground enough to put together this overview, so I think a lot of it was covered during the panel presentation, but just to remind you of these individual managers, of course, we've got PIMCO coming in first. You did receive electronic copies of all these presentations. PIMCO, in light of all that's been going on in the markets, sent a little short one that's about 10-page handout, which I put at all your places. It's white. No, it's not the booklet, and I don't have, it's white with a little red symbol down in the corner. It's not a book, Dr. Miller, yes. They will be using that for their presentation. They wanted to spend more time on talking about their outlook for the market and what they're seeing and that sort of thing. They thought that might be of more benefit to you. They'll certainly cover their performance information, but they wanted to spend their time today talking about PIMCO's insights into the market, and I think that's probably good. Of course, PIMCO's been a manager for us since 1983. They manage an $850 million portfolio, focused primarily on macro factors. They are one of our two core active fixed income managers. The next firm that's coming in, and in your Callan defined benefit plan book, you've got a tab called fixed income, domestic fixed income. So all these managers' performance information and all is found in that section of the book for your reference. Aberdeen will be the second presenter today. As I mentioned earlier, Aberdeen began with us in 1991. At that time, they were known as Warren Grenfell. So they now manage almost $620 million for us. They are a bottom-up bond picker firm, if you will. They look for undervalued bonds and build a portfolio from name by name from the bottom up. They did struggle in 2008, late 2008, early 2009, but have done a really good job prior to that time and since that time. So they will be the second firm today. They use a team approach for managing this portfolio. They have 8 portfolio managers that oversee 5 different sectors within their portfolio. So Lima Sales is our sole Core Plus manager. They manage $680 some odd million for us. They were hired in August of 2009, so relatively short track record. They have during that time really their plus exposure has been in the high yield sector. So this will actually be, I don't think we brought them in last year because they really didn't have a long enough record. So this will be one of, if not the first, one of their first presentations to this board since being hired. And the Wellington Emerging Market Debt portfolio is our only sole non-U.S. portfolio. As we mentioned earlier, they invest in emerging market sovereign debt, which is U.S. dollar denominated. From a very top-down approach, they were hired in May of 2010, so they just barely have a one-year track record now. They were funded with $340 million, and their portfolio is $388 million today, or as of June 30th. So, and they focus on, they've got 4 portfolio managers on the portfolio. Wellington, the firm, has a very deep research bench, so they have lots of analysts all over the world, and they take advantage of that research information. They focus on economic decisions, currency, and political analysis in making their security selection in the emerging market space. So those are the active fixed income managers that are coming in today, and I think it'll be a very big group. We've got managers who are solely U.S. focused, and then managers who are looking outside of the U.S. and in some non-core sectors. So it'll be you should be able to get a good overview of what these folks are thinking about the economy, about interest rates particularly. And please ask them any questions. They all have opinions on what's going on or what's going to happen, or what they'd like to see happen, and how they're positioning portfolio to adapt to the changing environment. So if there happy to address them. If not, then we will start off with PIMCO. Let me take 1 second and introduce George Dadu. George is the newest addition to the investment staff. He'll be formally introduced tomorrow as a new employee, but George is doing a great job with us starting 1st of August, and these will be his managers that you're hearing from today. So. Yes.
You checked the market.
It was up 115 points. I don't know what it is. It's much
As long as it's more than that.
Yes, yeah. Starting off a better week this week.
She said, this is peanut butter. You got it right here. She said something about they were going to.
Yes, they're going to
She
use.
still the bill.
They said they would still be responsible for the material and the book you were sent, but they want to work on this little handout.
Good to see there's always room when someone brings a bigger team.
Mr. Chairman, we have representatives here from PIMCO, and I'm not sure who's going to do introductions. Okay, Brent Holden is a familiar face here, as is Michael Canada, so I'm going to turn it over to Brent. Everybody has both presentations, but we understand you're going to work from the white.
Okay, I would say as we were preparing for the meeting, literally on Friday, and we were thinking of how far the markets have come just in the last little bit, we knew that having a book that ended on June 30th sort of met the formal requirement of reviewing a fiscal year period, so we're prepared to do that, but we thought that it might be a little in the less is more, that if we could substitute a 10-page book as opposed to a 27-page book, it might be a little bit easier for y'all to follow. So we'll do that, but if there are questions from the original, we certainly can go back to those exhibits. What I'm going to do is kick off. What we're going to try to do in the time here is review 3 different investments that the Mississippi Retirement System has with us. You have the largest is a core bond portfolio and your defined benefit plan. You also have a fairly similar strategy, but a smaller investment in the 457 savings plan, and that's invested in a mutual fund. And then you also have had what I would call a private fund or private equity investment that's been in the defined benefit plan that paid out towards the end of the fiscal year period. So we're going to be trying to talk about all 3 of those. Before I turn things over to my colleagues, I'm going to kick off with a little bit of an organization update and then just make some summary points that hopefully paves the way for the detail to follow. And I'm on just page 1. This, by the way, this page, we're not going to present every bullet here, but this serves as the minutes for our comments as well. But quickly, in terms of organization, PIMCO actually, through this, since you last saw us, we've actually been very, very stable. I think a lot due to the fact that we had very rigorous risk management through the financial crisis. We actually, I think, protected our clients' principal quite well, and we've actually been a beneficiary of flows. We've created some new strategies, such as the TALF investment that you were invested in, that have actually paid off pretty well for our clients. So what we've tried to do through this period is to reinvest some of the revenues from that into bringing new capabilities, new staff and technology into our firm that we can use to benefit our clients. The one change in terms of staffing, and there's probably a fair number of new people at the firm. The one departure we had actually was the primary portfolio manager on the retirement system portfolio, Paul McCulley, retired. retired at the end of December of 2010, and he's sort of joined a think tank, and I'm sure he'd love to be on the Federal Reserve Board someday, but at the moment he's sort of doing more academic pursuits. And Mark Seidner, who's another one of the managing directors of PIMCO, he's on our investment committee, which is just a 6-member committee. So he's, you know, absolutely within the inner circle of strategy development. He's the primary portfolio manager on your portfolio, and he really has not skipped a beat. He's running in a very consistent manner. He met with us in detail to go over the history of the account. He understands the guidelines of what we can and can't do, and it's done well under his supervision. I'll also say if he's actually, amazingly for a portfolio manager, he's pretty easy to understand. So if you ever do want to meet him, we're not afraid to bring him here. This time we just felt with the markets as volatile as they are, keeping the portfolio managers at their posts is a little bit more of a priority. Let's see, with that being the organization update, just a couple of themes as we talk about I think I said something wrong there, sorry. So just in terms of some simple themes, obviously you're watching the news and seeing, you know, a fair amount of volatility, particularly in the equity markets. And you know, generally speaking, bond portfolios do well in that period. Perhaps the surprising part is that at a time when the U.S. Treasury's debt gets downgraded on its credit quality, it actually sparked a huge flight to quality rally, more or less away from stocks and riskier corporate bonds into treasuries. So they've done better than I think most people, including PIMCO, would have thought. For the fiscal year period, the sort of June to June, your actively managed bond portfolio of PIMCO had very, very strong outperformance. For the July and August to date period, we've underperformed a little bit, but if you went to the, what would be 13 and a half months, we're still more than a percent ahead of the index. So we're doing well. We didn't own quite enough treasuries through this last spike of the rally, and you'll see some numbers that show that. The 457 plan investment has not kept up quite as well. We'll talk more about that. It's the smaller investment. It's got more flexibility, and actually over the long term is better for those participants. But sometimes when we can do everything, it works out better than others, and this has been a period where the extra flexibility did not work as well. So again, I'll save that for my colleagues, the detail. Countering that though, this TALF investment, the private fund investment you've had, has done exceptionally well, and that paid off in your fiscal year, and we'll be updating that. The last bit is, in terms of where we go from here, which is part of why we try to condense the book. From an economic outlook point of view, I would describe PIMCO as cautious. There's some real difficulties ahead, and certainly there could be some policy responses that would help, but if we don't get those, you know, the Federal Reserve has done a lot already. They have limited options. It would really help to get something more out of Washington, but whether, you know, the nation really wants to do some of the things that might help stimulate short-term economic growth or not remains to be seen. We also can conclude, you obviously have liabilities you have to cover, and you need investment return, and we do have ideas both in the bond portfolio and even beyond that of strategies that could make sense for the future. So with that, I'm going to turn things over to Alan Eisenberg to proceed, and I think we're going to skip to page 3 first, and then we'll be coming back to page 2 that has all the raw performance.
Thanks, Brent.
Brent, can you just introduce Alan, because I don't think
gosh.
the group knows him.
All right, sure. Sorry. Alan Eisenberg is an account manager here at PIMCO, who's, I guess if we round up, he's entering his 2nd year with us. And tell me where you graduated from again? Okay, so he's from Wharton Business School, and he's formally assigned on the team to work with Mike and I in the Mississippi relationship.
Thank you. Thanks, Brent. It's very nice to be here and to meet all of you. We actually had the pleasure of meeting the Lieutenant Governor on the way in, who's considerably handsomer than his characterization in that cartoon over there. But anyway, so wanted to quickly delve into the structure of the portfolio of the separate account. And if we look on page 3, we can see essentially that it's been the year that we're looking at in review, the 2010 fiscal year, was a year in which sort of what we would call spread sectors outperformed. What we mean by spread sectors is sectors that benefit from trading at a wider, a higher interest rate than just pure treasuries. So if you look, for example, at investment grade credit, right? Investment grade credit is an area where you're compensated not only for the actual coupon on the bond, but also you're compensated for taking the credit risk of investing in that company. So with high quality, it's a very minor risk, but it's still a risk that you're paid for. And so in that case, with respect to investment grade credit, that did very well. Another area that did very well are municipals, particularly the Build America bonds did quite well in the fourth quarter of 2010. And the reason for that is that this Build America bond program, which is a taxable municipal program where the federal government subsidizes a portion of the investment, it was not renewed. And so as a result of the fact that it wasn't renewed, you saw an increase in demand with a decrease in supply. And so those assets did very well over the course of the year. And so that was a good opportunity for tax-exempt plans like yourselves. Finally, commercial mortgage-backed securities, which is the yellow chart farthest to the right on the page, what we abbreviate as CMBS. About 10% of the portfolio is invested in these commercial mortgage-backed securities. And what those require to sort of invest judiciously is very diligent research into each specific security. And so that's an area where PIMCO has 40 dedicated credit analysts who focus specifically on looking at these credits, ensuring that they're sound investments. And so security selection is a very important additor of value in that context. So if you look in contrast at treasuries, which is the fourth blue bar from the left, treasuries did not perform as well over the course of the past year, past fiscal year, because investors were willing to take more risk. Part of the Federal Reserve's program, the monetary stimulus, we call QE2, the quantitative easing program, was geared to send investors into riskier asset classes, stocks, investment grade credit, commercial mortgage-backed securities. So PIMCO leveraged that and was able to take advantage of that to add to performance.
We didn't use leverage in your portfolio.
Sure. No, of course. To leverage the opportunity, not to leverage the portfolio. Exactly. It's an important distinction. So if we look at page 4, we can see specifically how the plan performed. And just to give you some context for the chart on the upper left, what we mean by duration is that's the price sensitivity of the portfolio to a change in interest rates. So essentially, the more duration a portfolio has, the more its price will change as interest rates move. And so PIMCO, for much of the year, maintained an underweight such that our securities were less price sensitive to a change in interest rates than the benchmark that this portfolio is measured against. As a result of the flight to quality that we've seen lately in terms of investors moving to treasuries as a secure asset, we've actually increased that duration such that we're now neutral with the benchmark, which is to say equally price sensitive as the benchmark would be with respect to a change in interest rates. So taking a look at the chart on the upper right, this shows the performance of the portfolio with respect to the benchmark and how PIMCO's investments added to performance, or in a few cases, detracted from performance. So over the last 12 months, our positioning in terms of interest rates has been additive for performance. But in the second quarter specifically, in light of the fact that the firm took an underweight to treasuries, that detracted from performance as investors moved towards treasuries as part of this flight to quality that I mentioned earlier. In mortgages, we were slightly underweight to agency mortgage-backed securities, and those performed well over the course of the year, so that modestly detracted from performance. But the most significant element of performance over the 2010 fiscal year was in the credit sector, and PIMCO's position in financial names and in investment-grade credit generally was very positive for performance, and I'll get into the specific numbers in a moment. And then finally, as I mentioned before, with municipals, taking advantage of those taxable municipal programs in a portfolio, a tax-exempt portfolio like Mississippi PERS, was beneficial for performance. So if we look at, actually, if you don't mind, we'll jump back to page 2 for a second and just talk about the specific numbers and touch on 2 of the 3 investments that your plan has. First, if we look about halfway down the page on page 2, we see the quarter ending 9/30/10 and then the quarter ending 12/31/10. So if you look at the relative performance over that period, it's 130 basis points, essentially, of outperformance compared to the benchmark. And that had to do extensively with the firm's positioning in this portfolio on investment-grade credit, and it also had to do with our positioning on treasuries. If you look at the second half of the fiscal year, that's to say the quarter ending 3/31/11 and 6/30/11, continued to add to performance with 60 basis points over the benchmark. So a total of 189 basis points of alpha, of outperformance versus the benchmark for the 2010 fiscal year. So that's for and this is of course the $850 million separate account that we're referring to here. Also, as Brent mentioned, PIMCO manages through the 457 savings plan, manage an account that has $27 million in it. And that also outperformed on an absolute basis, though it did lag the benchmark, did not perform as well as the separate account. And this is what Brent mentioned in his introductory comments. While we do have more flexibility there, PIMCO essentially expressed the view that the yield curve would steepen over the course of that period and invested accordingly. What actually ended up happening is that the yield curve flattened, and so we made money for the portfolio from that positioning initially, but as the yield curve began to flatten, it detracted. So that flexibility in this one particular case was not helpful, but on the basis of absolute performance, was still quite successful.
And the number, like versus the 5.79 with the with the defined benefit plan separate account earned, the 457 plan earned 5.2%, which was still above the 3.9 for the Lumen Aggregate Index, just not as much as your separate account.
Correct, exactly. And performance to date this year has also been an absolute positive in that account. So with that, I would turn it over to Mike to discuss the third investment, the TALF investment, which is winding down now, but has been very successful.
Before you do, so
Sure.
be clear that since June 30th, the sort of third quarter to date, those numbers are the final 2 lines down there. So doing some fairly simple math, you're up for this third quarter or fiscal year, I don't know if you call it fiscal year 2012 today, you're up around 3%. The index is up about 3.6. So we're trailing the index, but it's really just that we don't have as many of the treasury bonds that have just in the very short term been going up a lot in price. We have things that are going up, just not as much. And then in the 457 plan, that one's up about 1%. So.
Great, thank you, Brent and Alan, and thank you to the board for your time today. I see a lot of familiar faces out in the audience right now, and you may recall that back in May of 2009, Mississippi made a very tactical, opportunistic investment into a fixed income market, that being the consumer finance market. As you may recall, the conduit for consumer finance somewhat closed as a result of the financial crisis. And to help re-stimulate consumers' purchases of automobiles, student loans, credit cards, the government stepped in and put in place a very short-term program to help stimulate the markets, and you participated in that market as well. Very happy to say that it's been a very profitable investment for Mississippi PERS. The return on that portfolio was about 34.3% since inception, and is now completely paid off, so those gains are locked in. You may recall that you made a $50 million allocation to the strategy And unfortunately, it was a very narrow window of time, so we were only able to put to work 35% of that money, and then did not call the other 65%. So we put to work about $17.5 million on your behalf, and it was a very profitable investment. So congratulations. Yes.
Was involved in that when you said automobiles, did investments like this help the government have the money to pay that big down payment? For example, I have an old pickup in the Alchemy 4200 trade-in.
Right, cash for
They
funds
take
for.
what?
Yeah.
That was actually a separate program that was looking to stimulate the automobile market. This was more making sure that consumers that wanted to buy automobiles were able to secure financing to be able to do so.
It helped people get loans too. Now, if you took out a loan, it might have helped you. To buy
I
the new
didn't
car.
take out anything, I'm still driving. I'm still driving my 93.
So, I knew it was somewhat of a leap of faith for the board to take that. It was a very narrow window, and we actually moved quickly. You did so, and it was very profitable. So thank you for the trust you placed in for that investment. Turn to page 5. We can talk about the recent market environment, and it's been volatile, which is the reason we put together these supplemental materials. Frankly, the period ended June 30th looks very different than today. The events in the ground. If you look at the chart at the top right-hand side of the page, this is a chart that's known as the volatility index or VIX index, but I like it by its nickname, which is the fear index. And as you can see in the shaded region towards the right of the chart, fear in the markets has increased measurably, and this has been caused by a lot of different reasons. First, there's been an intensification of the European debt crisis as more and more countries have become subject to fear. The U.S. debt ceiling fight and the near default on interest payments by the U.S. government. I don't know if we actually got that close, but it seems to be the path we were heading. And then also global growth has slowed markedly, both in developed markets like the U.S. and Europe, and also there's been a slowdown in growth in even some of the emerging market countries. Because of that, we've seen a pretty dramatic sell-off in risk assets, most notably the equity markets. And we show on the middle chart the return of the S&P 500 with the yellow line. As you can see, equity markets have been down close to 20% since their recent peak. And this has been seen not just in the S&P 500, but also small cap stocks and international stocks as well. We've also seen a sell-off in corporate bonds. The spread that you get paid over treasuries to own a corporate bond went from around 1.5% at the end of the quarter to now around 2%. So it's good if you're buying corporate bonds right now, but unfortunately they have underperformed somewhat in the most recent period in this flight to quality. In flight to quality, you can really see in the bottom chart. The blue line shows the 10-year treasury. As Brent mentioned, despite the U.S. downgrade, it's still seen as a safe haven asset and has rallied very strongly in the recent month and a half. Gold has also performed very strongly. We show this a little bit more clearly on page 6. And what we show on the top right chart is 10-year rates in a variety of different locations. On the far left is the U.S. And what you can see is that the U.S. Treasury rates went from close to 3.5% at the end of the first quarter, 3.31, down to its current level of just about 2%, and actually has traded below 2%, which is a record low for Treasury bonds. This has been seen not only in the U.S., but also in the U.K. and the European Union, as seen on the right-hand side of the page. Importantly, if you look at the middle chart, expectations are now for rates to remain low for a considerable period of time. What we show here is expectations for rates at the beginning of 2013. And you can see that in prior periods, either at year end or at the end of the first quarter, there was expectations that the Fed would be hiking rates and bringing short-term rates higher. Those expectations have collapsed, and the Fed has actually confirmed that they're going to stay on hold until mid-2013 to try to right the financial markets or the economic markets. What this means for investors is that, unfortunately, if you're owning Treasury bonds, you're not getting paid a lot to do so. We show that on the bottom chart, which is a chart of real U.S. yields. And the easy way to look at it is that if you're going to buy and hold a treasury security up to 10 years of maturity, if you subtract out inflation, your return is going to be negative by holding that treasury security. So it is causing investors to consider, what is the role of fixed income in my portfolio? It's supposed to be a source of diversification. It's supposed to be a source of stability. But given the low levels of yields, we are talking to investors about what do you do in this type of environment. But the question is, why is this outlook so weak? Why have the rate markets moved the way they have? Turn to page 7. We give you just a few of the reasons. We could list off a lot more, but some of the key reasons here in the U.S. are the housing market. Despite record low mortgage rates and greatly improved affordability due to the decline in housing prices, we would have expected to see a much larger, surge in housing market activity, but this is still not been the case. People are not going out and buying new homes. Also, unemployment, though it has come down from its peaks, is still at very high levels, above 9% of the unemployment rate. And as people have stayed unemployed for much longer, which we show with the middle chart, the yellow line, a lot of the unemployed have been unemployed for a long time, 6 months or greater, which is causing people to change spending patterns and have a real detrimental impact on consumption here in the U.S. And on a related note, debt in the consumer balance sheets remains very high. So you're not able to go out and use your credit cards and make purchases if you already have too much debt in the U.S. consumer. What that means is on page 8. And at PIMCO, we talk about a framework for looking at growth expectations in the developed world. And we categorize it into 4 different scenarios. A, B, C, and D. An A scenario is going to be more of a traditional recession and then recovery, what's called a V-shaped recovery, a very quick resumption to normal spending patterns and normal levels of GDP activity. We never expected that. We thought that the repercussions of the 2008 crisis were going to be stark and last for a long time, which is closer to a B scenario where there's going to be slow growth for a period of time, but an eventual reversion back to the mean. Even that we thought was more of an optimistic scenario than what we were expecting. What we were expecting, what we called the new normal, is somewhat of an L-shaped recovery where we fell in 2008 and it was going to be very slow growth for the foreseeable future. That appears to be the scenario that we're in right now. And then the D scenario is all the bad D words. Depression, deflation, not a very optimistic outcome. And we always thought that was a risk case. At the beginning of the year, we thought we were in somewhat of a C+ world, with slow growth, but some chance of a better result. Unfortunately, due to some of the events we listed in crisis in Europe, and some of the big slowdown in growth, we now think there's a higher risk of a D scenario. And when faced with a D scenario, there's very few things that markets can do to self-recover or self-right some of those negative feedback loops. So you really need policymakers to step in and provide some source of stimulus. And we turn to page 9. We show some of the tools that policymakers have to affect outcomes. The first is monetary policy. So you can think of that as actions taken by the Fed Chairman, Ben Bernanke. Ben has taken some measures to try to stimulate the economy. He's announced that rates are going to stay on hold through mid-2013. There's talk of an additional round of stimulus, of bond buying to reduce interest rates. Notice quantitative easing 3. There's no speculation of that. The Fed is doing what they can to stimulate the economy, but they can only do so much when they've already got rates on hold essentially at 0. Which turns to the fiscal stimulus, and that's going to be actions taken by President Obama and the Congress. And as we saw from the recent debt debate, it's going to be very hard to get any kind of new stimulus measures passed at the federal level. I think that's been pretty apparent from the events of the last few months. Very similar situation in Europe and other parts of the globe. There's some monetary policy tools, but not many.
But what you would wish for is that they would trade some long-term fiscal restraint, which unfortunately would need to include some of the entitlement programs. But if you could tinker with some of those and phase them in and all of this, you could probably save trillions off of the expected long-term budget deficit, and then that would allow you to maybe do some more jobs programs and things to get people back to work in the short term. But it's just been a difficult environment. It seems like the Republicans all come in and say, okay, everything's on the table except taxes, and then the Democrats come in and say everything's on the table except entitlements. And it's really hard to do. You're trying to get 100% of the work done with like 10% of the budget. So, but anyway, there is a strategy that would work. It's just not necessarily politically feasible. It is economically feasible.
So we have our doubts that stimulus is going to be able to provide the necessary stimulus to the markets to help the equity markets at least do very strongly in the near future. And same with the fixed income markets. We positioned your portfolio, as we show on page 10, very conservatively. We're emphasizing quality. Thank you. What we've shown here is actually a full discretion portfolio that has some tools that we don't utilize within the Mississippi plan. The items in bold, though, are tools that we use within your investment strategy. So, emphasizing high-quality corporations that we think have the ability to pay back debt in a variety of different economic environments. We're emphasizing mortgages with very high credit quality, municipals that we think, again, essential services, water, transportation, things that people need to go on with their daily lives. And again, as Alan mentioned, we're somewhat neutral in terms of duration within your portfolio. We're cognizant though that with fixed income yields, at least for the benchmark, below 3%, that's not going to take your actuarial rate of return. You're going to need PIMCO and your other active managers